Hi, I'm Sean Rickerby of Rickerby Wealth Group at TD Waterhouse. Welcome to our first in a series of videos designed to help you better understand your investment options. When it comes to putting your money to work, you have basically two choices. You can either lend your money and earn interest, or you can invest in a company with the expectation of earning a profit. Every investment has some degree of risk, with cash being the safest and shares having the highest degree of risk. To complicate things, different investments are treated differently for tax purposes. Today we will start by examining bonds, which are interest-bearing investments and are usually called fixed income securities because they pay a set amount of interest on a regular basis. We also sometimes call these debt instruments. With fixed income securities, you expect to get your money returned on a specific date, usually called the maturity date. During the period your money is invested, you receive a regular interest payment, which usually varies from either monthly or semi-annually. You can usually arrange to have these interest payments credited to your bank account where it's appropriate. Now, you are probably familiar with some of these investments already, such as Government of Canada savings bonds, term deposits, guaranteed investment certificates, government bonds, corporate bonds, and even mortgages. The interest rate you receive on your money is related to the risk that you may not receive the return of your original investment. We call that the principal amount. The greater the risk you face that your principal might not be returned, the higher the compensation or the interest rate you'll want to receive on your investment. If the entity is unable to return your investment at maturity, it is said to have defaulted, which is currently a concern for anyone that has lent money to some countries such as Greece. As a guide, there are several independent bond rating services, such as Standard & Poor's and Moody's in the United States, and the Dominion Bond Rating Service here in Canada. And they provide independent ratings for much of the debt currently issued by both companies and countries around the world. However, there is a bit of guesswork involved in providing these ratings, so they should not entirely be relied upon. Conservative investors use bonds to provide a steady income, often buying a new bond when it's issued, receiving the regular interest payments over the lifetime of the bond, and then receiving back their principal upon maturity. Bonds that have a very short duration to maturity are often held as a quick source of funds for emergency purposes. Now, in addition to the risk of a default, if you own bonds, you're also exposed to interest rate risk. For example, if interest rates increase, you would lose the opportunity of receiving the higher rate of return now paid on newer bonds. Rising interest rates usually result in a temporary drop in the price of any bonds that are currently outstanding, which are paying lower interest rates. Therefore, if you wanted to sell your bonds prior to maturity, you would potentially get a lower price for them. The other risk bondholders face is rising inflation, whereby the principal returned to you at maturity won't buy you as much as it did on the first day you purchased the bond. Although the bond market is far larger than the stock market, very few bonds actually trade on an exchange. They usually trade directly between large investment firms, mutual fund companies, pension plans, and insurance companies. But typically you need to have at least $15,000 to buy a bond. Therefore, for individual investors who are just starting their investment career, bond mutual funds are perhaps the ideal alternative, as they can be purchased in smaller amounts. Fund managers are paid a management fee for managing these risks on behalf of investors. And because a bond fund in turn invests in a variety of bonds, this also reduces any risk of default by a singular bond issuer. Another advantage of owning bonds within a mutual fund is that you can easily buy and sell small amounts of the fund. Now, that being said, if you have a larger enough portfolio, you should be able to achieve diversification and liquidity through a laddered approach of direct ownership in bonds yourself, and thus reduce the cost of investing in bonds. Our next two segments will take a closer look at bonds and where they may fit in your portfolio. For more information, please call me at 604-482-5188 or email at sean.rickerby@td.com. We hope to hear from you.